Have you wondered how we can focus on the enterprise or operating activities of a firm rather than on the company when using the economic profit framework? In this video, we'll look at how we can do this. Focusing on the enterprise, not the company, can have several significant advantages, including we do not need to change the cost of capital with changes in leverage, and we only need to focus on the risks of a firm's operations. This can better focus our efforts in analysing our firm's financial statements on those aspects that are potentially adding value. This should help us more effectively engage with the economic and business realities of our firm. If we think the financial activities of our firm are not adding value, we can recast the economic profit model as the value of equity equals the opening or current book value of equity plus the present value of abnormal operating income. Let's see how we can do this. The economic profit framework can be expressed as value of equity equals book value of equity plus present value of abnormal earnings, i.e., if all the items in a firm's balance sheet are at market value, then the book value of equity could be expected to earn at the required rate of return. Abnormal earnings would be expected to be zero. Another way of saying this is value of equity equals book value of equity. This implies forecast abnormal earnings, AE, equals zero. In principle, if the accounts could include everything at market value, then financial statement analysis would be totally straightforward. We could simply accept the book value of equity as equaling its market value. Unfortunately, this is not typically how accounting works. Even if some items in the balance sheet are at or close to market value, there will be others that are not. Accounting generally does not seek to capture estimates based on expected future economic and business events that may affect the firm's future earnings. And where it does, these will be subjective and open to potential manipulation or to various biases in their estimation. However, some assets and liabilities may have zero expected abnormal earnings because they are measured at market value. We can express our economic profit framework as follows. Value of equity equals book value of equity plus present value of abnormal earnings from net assets not at market value. The reason we can safely exclude net assets at market value when calculating abnormal earnings is because by definition they will not contribute to abnormal earnings. All their value will be captured in the accounting book values. If we think our firm cannot add value from its financial activities, that is the same as saying that the book value of its financial net assets is the same as their market value. We know that equity equals net operating assets minus net financial obligations. The net operating assets of a firm are usually not at market value in a firm's balance sheet. This means that the abnormal earnings from net operating assets, that is, abnormal operating income, can usually be expected to be material, either positive or negative. The value of net operating assets will equal the book value of net operating assets plus the present value of abnormal operating income. We also know we can calculate the value of a firm's equity by deducting the value of a firm's net financial obligations from the value of its net operating assets. This can be restated as the value of equity equals net operating assets plus the present value of abnormal operating income minus the book value of net financial obligations, which can be rearranged as the book value of net operating assets minus the book value of net financial obligations plus the present value of abnormal operating income, which equals the book value of equity plus the present value of abnormal operating income. Do you see what has changed? The present value of abnormal operating income has replaced the present value of abnormal earnings on equity. If a firm's net financial obligations are at or close to market value in its balance sheet, then we can focus on abnormal operating income rather than on abnormal earnings. Or in other words, we can focus on the enterprise or operations of a firm, regardless of how it is financed by equity or debt. For further information on focusing on the enterprise, go back to Chapter 6, Section 6.1 in the study guide, and also review Focus on the Enterprise weekly questions. Also answer, write and rate questions on Focus on the Enterprise in Peerwise.